Hey everybody, welcome to the Crowdinvesting for Startups campaign. I'm so excited to bring this panel together. We have representation from some of the top equity crowdfunding platforms in the world, and we're here today to talk about how crowdfunding and startups can go together. We're going to go around, ask a few questions, learn how you can take advantage of this opportunity as a startup, and learn what trends we're seeing in the industry in regards to the unique opportunity they can present to you. I'm going to go right to Alan. Alan, would you introduce yourself and talk a little bit about the platform you represent and some of the unique features why startups might find you interesting?
Sure. Hi, everybody. My name is Alan Jebsen. I am Vice President of Sales and Business Development at StartEngine. And StartEngine is a leading equity crowdfunding platform in this space. We offer investments to both non-accredited and accredited investors. But I think what makes us a little bit different is our experience in the space. We launched actually the first ever equity crowdfunding open to non-accredited investors under Regulation A+, all the way back in 2015. A company called Elio Motors that kind of kickstarted the industry itself. So we've been in this space for quite a while. And then most recently, I would say our biggest innovation is we actually raise capital from the crowd for ourselves. So we have equity crowdfunding rounds available to anybody to actually invest in the platform that is StartEngine. So not only are we a platform that helps startups raise money, but we're also a platform that helps ourselves raise capital from the general public.
Oh, thank you. Love StartEngine. Stefan, would you mind chiming in?
Hey, I'm Stefan. I'm a founder in residence here at WeFunder. Previous to joining the WeFunder team about 2 months ago, I was leading a YC self-driving truck startup called Starsky Robotics, which raised $22 million or so in total. And that's kind of one of the big things about WeFunder. At WeFunder, we're also one of the original equity crowdfunding platforms. We've been around since 2013, 2012, and actually helped bring in the Jobs Act that allowed equity crowdfunding. But one of our big focuses is on really high quality companies. So we actually reject the vast number of companies that initially reach out to us, and are doing a number of programs like the Accelerator to better refine and pick really great companies that are then going to go on and raise large amounts of traditional venture and other sources of funding.
Great, thank you, Stefan. And Jovan.
Thanks. I'm Jovan Vojvodic. I'm here from NextSeed. Yeah, so NextSeed, as was mentioned by others, was founded in 2015. We actually were the first nationally licensed regulation crowdfunding site. We also were the first ones to do a national regulation crowdfunding distribution back in 2016. In 2019, we applied for and received our broker-dealer license. So in addition to being able to do transactions, issue securities under the Reg CF exemption, we can also do Reg D, Reg A plus, Reg A transactions as well. I think from our perspective, you know, what we generally have been doing from a risk return profile is we've generally worked with brick and mortar companies, and we'll talk a little bit about how COVID has impacted that over time. But for the most part, the transactions that you'll see on our side, I think we're maybe a little bit differentiated in so far as we're not really looking for the next unicorn per se. Most of our risk return type profiles are going to be something more akin to, you know, what you would think about as being a private equity probably versus a VC model. So we're looking for, you know, on the equity side returns, you know, projected returns in the 30%, you know, on the debt side returns in the 15%, capital preservation. So the idea here is you're not going to make 100 times your money, but you're going to make 3 to 4 times your money. And again, it's a bit more of a zebra versus a unicorn type of approach in regard to the types of transactions that we curate for our investors.
Thank you, Jovan. I work with a lot of people that are raising or looking to raise, and I think a common mistake they make, and I don't know if you'd all agree with me, is they have this idea, they're very early, and they think they just blanket every crowdfunding site and just hope somebody connects with them. I tend to look at it as, each platform, and I mean this, very seriously, brings a unique offer, especially at the top tier, which all of you represent. And I'm curious, where do you draw the line in your platform as far as the types of companies you like to list? If I'm a startup founder and I'm considering coming over to your platform, a lot of us are early, right? I'm working with very early people. Where could you set a bar or a range bar early so that people have a good idea if they fit into your platform? Stefan, would you mind starting that for us, please?
Yeah, of course. I mean, I think one of the things that's really important to us is that when investors are investing in companies on WeFunder, they're doing so for what we kind of vaguely define as the right reasons. So people aren't putting money into something thinking that they'll get 1,000 times their return in 3 months because of something they've seen or something the leadership team has said. But really what that then requires is the companies that are on our platform need to have enough proof that investors can make the right type of decision as to whether or not to invest. So whether that's a brewery, that might mean that they're already shipping products, people already love them, their fans are already participating in the round. Whereas for a startup, it probably means either they've built something really cool and exciting that already clearly seems to mostly work, or they've built something that is so loved by its community that community not only uses it, but then wants to be a part of it.
Awesome. Jovan.
Yeah, well, I touch a little bit on kind of how we think about the risk return profile. I think just from a, kind of a 30,000 foot view, it probably makes sense to say from a, transaction size perspective, we generally are looking to find issuers who are looking to raise anywhere from, call it, 100,000 to, 5 million. Generally speaking, what we are looking for when we're talking to folks, as I mentioned before, we have the regulatory cover and we have the in-house expertise to underwrite pretty much any type of business, B2B, B2C, et cetera. Where we found that we really shine for our issuers is in a B2C context, where basically we are using the offering, the capital raise really as an opportunity to go out and market and brand the business itself. And so obviously in a perfect world, what we find is people who are not only investors, and financially invested in the company, but also are emotionally invested in the company, they're brand ambassadors. And that really tends to work best in a B2C type of a context. Having said that, what we generally like to see when people are coming in to talk to us about being issuers is that there is some proof of concept. Again, we've done pre-revenue transactions, but for the most part, we like to see at least some kind of revenue trajectory. We also like to see that, if we're going to raise whatever $1 million, we'd like to see that at least 20% of that is going to come from their internal network. Generally speaking, on our platform, 80% of the subscriptions come from what I'll call our network that we bring to the table, but we kind of expect issuers to be able to come up with 20% of the capital raised through their own friends, family, network, et cetera. We kind of feel like that's a big part of kind of how we get comfortable with proof of concept and the fact that there is some some grassroots level support for these businesses.
Yeah, I feel, almost every top tier platform has almost a requirement to bring some investors with you, and that works for crowdfunding in general. It's great to come out running, as I like to say, or start off with a bang. And I imagine from, I get a lot of people that are just way too early to even be considering raising funds. So I imagine that's a nice filter, because I can only imagine how many contacts and submissions you get on a daily basis, and trying to manage all of that information takes tremendous resources just to review people to get through. So helping people understand where they should be getting in is part of what I do every day. Alan, what's your take on that and kind of where you draw the line as well?
Yeah, I think I think it's a great question. I think as both Jovan and Stefan know, it's hard to categorize if you're at this stage as a company, you're right for equity crowdfunding. It's different for every business, whether it's retail, whether it's tech, whether it's e-commerce. Some of our strongest raises are B2B companies with a concept, but not too much traction. Or you look on the other end of the spectrum, a true B2C, tons of fans and just kind of perfect for crowdfunding in general. They already have a large amount of brand ambassadors that are so excited to join. I think what really, and Jovan talked about this, is having the ability to kind of say, what assets can you bring to the table? I think equity crowdfunding is not a place where a startup can, what we call like post and pray. You post the offer on the platform and then you wake up the next day and you get $1 million. I mean, it would be amazing if that was the case, but as we know, it takes a lot of work. So what we really try to identify in the screening process is a founder's willingness to be vulnerable, to be open, to go out to the public, and really be excited to take advantage of equity crowdfunding. Sometimes we talk to founders and, they say, okay, well, how much can StartEngine bring to the table? 70%, 80%? That doesn't seem like good enough for me. I was looking for more 100%. I've got to focus on other things for my business and I've got to take care of 100 different things. To us, that raises red flags because we know if a founder is really going to do good by their investors and potentially have 500 or thousands of investors, they've got to be really excited to take advantage of equity crowdfunding. And they got to really want the ability to have a group of brand ambassadors to not only bring into the company, but to go out to them about new product updates, beta testing for their companies, or for their products. So I think one thing that we look for is really a founder's excitement and openness to put themselves out there and raise via crowdfunding.
I love that. And part of me wants to hold back a little bit because I don't want the cheat codes to get in, right? So I look at, I look around the industry. I've met thousands of entrepreneurs that have been through equity crowdfunding, but I've never been in the room where you're making the decision to list them or not. That's a fact. So I've always had this curiosity on where those lines get drawn. And what I meant by cheat codes is, this entitlement mentality I run into in some entrepreneurs where they feel like, hey, I got listed, I'm the entrepreneur, I'm bringing this deal to you, and you're not doing enough for me as a platform. That's an attitude I see from entrepreneurs that I've worked with far before equity crowdfunding was here. And that's just not a path and a mentality to success. And so, telling people to have the right attitude, to be vulnerable, I actually don't think you can fake it. So I don't mind sharing that. I think that's really important. If you're an entrepreneur out there and you feel like a platform owes you the whole world just because you got listed and because you're an entrepreneur and that kind of thing, you probably have the wrong mentality all around. So that's my own personal opinion. Wanted to talk a little bit, kind of switch gears a little bit, and I appreciate everybody's comments on that. The market right now, right? We're going through sort of this, hopefully this mid or wind down on a pandemic, but maybe it's going up. It's kind of unknown. Kind of caught me off guard. The industry as a whole, I work with people that are working with VC as well as equity crowdfunding, and those funds, the family funds and VC, have all kind of bunkered down and stopped writing a lot of checks. Meanwhile, everything I've seen in crowdfunding shows a positive upward trend. And I know the spike kind of earlier on caught me way off guard. We were breaking records on some platforms. What I'd like to hear is a little bit of perspective from each of you on the early days of the pandemic and some of that climb, and then give me an update on what you're seeing like right now in the industry. Is there any slowdown? Is it getting any fatigue, or are we still breaking records or staying steady? Stefan.
Yeah, so to speak on that on the VC side, the VC industry itself had been coming for a reckoning for quite some time. Last year, a lot of funds were having trouble raising their next fund. You started seeing leaked things like that coming out of Andreessen Horowitz that its returns were actually worse than the S&P 500, which is kind of shocking when you think of the management fees and the carry that they're able to command. So the VC industry kind of got itself to a point of not being incredibly healthy. And then the pandemic happened, and it wiped that. It made that even worse. And I think that's part of why my guess would be everyone here on this panel has seen an incredible increase in demand, both on the company side and on the investor side over the last, call it 4 or 5 months, as we've been in this new normal. And my suspicion is that this isn't going to change anytime soon. The GPs at bigger funds that I'm close to are seeing no end to the scary times, and I think that's going to make for a continuingly robust environment for equity crowdfunding.
And if you don't mind me asking, are you seeing, and I don't know if you have this data, I'm assuming you have some, but are you seeing an influx of bigger investors, more accredited coming in, or is this being sustained by new? I guess the real question is, are we seeing new people coming into this market at an unheard of rate? Or are we seeing more from the existing audience as well? And I guess where I define kind of that, what I'm curious about is the everyday American, the non-accredited investor, continuing to invest at a rate or more right now, or is it being offset by the funds kind of coming this direction, or a little bit of both? I guess that's.
Yeah, I mean, I think typical good advice if you're a tech person, you want to do angel investing, is that no more than 10% of your net worth should you put into angel deals. And a lot of net worths just got cut by 20, 30, 50% because of what's been going on in the market. And people who might be okay putting $1 million of their $10 million across 10 to 20 angel investments now really might only be okay with 200,000, or they might already have enough capital deployed, and therefore it doesn't really make sense. As a result, the traditionally robust Silicon Valley angel environment is a lot less robust, which means that those investors are going to fewer deals outside of the Bay Area. They're going into fewer of the deals in the Bay Area. And broadly speaking, that then means that many of the better companies that are inherently better investments are looking at equity crowdfunding in a way they might not have before. That and coupled with regulatory improvements, I think everyone on this call is continuing to up their game in what they're able to offer companies. And as the service offering gets better, as the competitive sources of funding get worse, it just makes for a great environment to invest in equity crowdfunding, which makes it a good economic model for an increasing number of investors around the country.
Awesome. Jovan, what's your take on that?
So our experience, again, I mean, going back to the idea that, we traditionally were a, heavy brick and mortar issuer platform. We actually saw a bit of a dip in the early days of COVID. I think I mentioned before that traditionally, 70 to 80% of subscriptions come from our investor base, and 20% from the ones that the issuer brings to the table. Or the transactions that we were doing in the heart of kind of the first wave of COVID, that almost flipped. We probably had 80%, 70% being brought to us by the investors, and we actually saw a real slowdown with regard to our investor base. That has righted itself, and so for the transactions that we are in the market with currently, we're back to that 80-20, with 80 being brought to the table by us. In regard to what we've done specifically and how we're thinking about everything in the COVID situation, clearly brick and mortar has been hit harder than probably, the tech sector or some other, virtual type sectors or web-based sectors. So, what we've really been doing is really thinking about and proactively looking at finding issuers who are, what I'll call play well in the COVID environment. And so that can be folks, again, who are still in the B2C concept of consumer goods, apparel, packaged goods, et cetera, but really have, solid web-based distribution. And in fact, have seen their distribution go up in the context of what's been happening with COVID. We have been doing a lot of discussions with virtual or ghost kitchens, who basically are prep kitchens for, takeout or delivery type of services where it's not really the dine-in type thing. We've been talking to some folks around technology directed at solving supply chain hiccups that have been impacted by, what's been going on with COVID, or identifying real-time inventory in brick and mortar now that it's kind of harder to, I went to a store recently and I had to make an appointment to go pick something up at Neiman Marcus or something, because you can't get in there without an appointment, and you want to know the thing is there before you go in there and get it. So ideas like that, as well as kind of, again, traditional brick and mortar that have been able to demonstrate an ability to negotiate curbside service, to go offerings, things like that, are absolutely still in the market. Our investors are active, and we are in the market currently with transactions, and we're back to that kind of 80-20 where we're bringing 80% from our investor base. So I'd say things have normalized, but there was a dip, and again, I think largely as a function of our issuer base, our traditional issuer base. We probably took a little bit of a step back before we could get back, right-sized again.
That's great. Thank you. And Al, what are you seeing over at StartEngine?
We're seeing rapid acceleration. It's pretty exciting. But before I go into that, we've been examining this right when COVID hit, looking at the venture capital industry and looking at the equity crowdfunding industry. What I found, we're all talking about how traditional funds, VCs, really have taken a hit, and the numbers have shown, and the numbers of investments, the deal flow, et cetera. But what I found was really interesting looking at the data is that this year, in the first half of 2020, larger rounds, 100 million plus, are actually on track to surpass last year in Q1 and 2 of 2019 versus Q1 and 2 of 2020. Wow. But it's the seed capital that has taken a huge hit. I'm down 45% year-over-year, first half of 2020 to 2019. So I think Stefan mentioned this earlier. That's where we're seeing equity crowdfunding really step up to the plate. When you've got VCs, you've got traditional funds, when a pandemic hits, they're putting much more of their portfolio back into companies already in their portfolio and propping them up instead of allocating it to new investments. Traditionally, those startup companies that would have access to that deal flow now are looking at alternative funding sources like all of our platforms. So we're seeing a huge rise of number of companies, and a huge rise and really just an increase of quality of deal flow as well. And I think that's starting to show on our platform and others. The amount that we were raising pre-COVID per week was less than $1 million across all of our platforms. That was in early March. COVID hit, we're starting to see a groundswell of the everyday American look at the market as something really unstable. They're unsure of how to allocate their portfolio, but the idea of becoming, a Shark Tank investor for just a few $100s is still appealing, and it's not going to break the bank. So a lot of investors really turned to equity crowdfunding, and we went from less than $1 million a week on the platform to just last week, 4.5 million in just 1 week. So we're seeing the rise really be incredible for the platform, for our founders, and really the industry. We're proponents of the industry. We want all platforms to succeed because it'll only make equity crowdfunding that much more known as a true funding source for any entrepreneur out there. So COVID has definitely, unfortunately, we can look at a few different industries have given it maybe an acceleration of the eventual fall in terms of remote work or business events meeting, we're on Zoom, or all of those different types of industries. But I think the destruction of traditional financing and venture capital, maybe it took COVID to really get people to turn towards alternative funding sources. And then, of course, what we're seeing is, since we like NextSeed and WeFunder, we've been in this business for years and years. We've put so much time and effort into building a platform that is as seamless as possible for an entrepreneur to onboard their campaign and raise capital. It wasn't easy back in 2015 and 2016 when we're still trying to figure it out. But we've had the ability to have those years of preparation, and we've married that with a huge influx of leads, an unfortunate result of this large-scale pandemic. And I think it's starting to combine into this massive groundswell that's lifting the equity crowdfunding industry. So founders that are now choosing equity crowdfunding, not only are they finding it a very viable option for their business, but they're also looking at it and saying, why not do it again? Why not come back for a second and third or fourth round of capital if this was so successful? So I think we'll start to get entrepreneurs that maybe thought of this as a pathway for a bridge round or a seed round to think, okay, this is a potential pathway for my entire life cycle of capital, not just seed, Series A, Series B, and as we start to raise more and more in the Reg A plus landscape. So overall, it's just extremely exciting for the equity crowdfunding industry.
Great. So there has been some history or some rumors prior to COVID that the regulatory was going to expand Reg CF from the million cap to the 5 million. I haven't heard much about that in the last few weeks. My hope is that something is moving forward. Do any of you have insights on what we might expect? Is it dead in the water? Is it still coming? Any guess at when we might see that 5 cap? Because the implications of what that would do for the industry, especially now, I know a lot of people that love Reg CF in theory, but it's just not quite the raise they need at the moment. And that 5 million cap, I think, would just open the floodgates of opportunity. And I'm curious if you would agree with that statement, as well as if you have any thoughts on what we might see or have heard anything.
I think it would be a massive help to the industry. I mean, you hit the nail on the head. We speak to a lot of founders who are looking for the 2 to 5 range for their business, which is a very sizable but mature amount of capital for a business that already has a lot of maturity to it. And unfortunately, when they look at the Reg CF regulation right now and the $1,070,000 cap, they're looking at it as potentially a portion of the round. So how much of their time are they going to allocate towards something that is a little bit different to them as in equity crowdfunding, if it's only going to result to 20 or 40 or 50% of the round that they need? So increasing that cap to 5 million while keeping the costs and the onboarding requirements the same, I think will just be a game changer. Personally, I think that will happen by the end of the year. I think the SEC is very interested in helping small businesses raise capital. I mean, this rule was announced, or the potential rule change was announced pre-COVID. I think it was in February, or when COVID obviously impacted it in March. So they'd already been thinking about this previous to a catastrophic event that really had potential to harm, or has the potential to harm, small businesses for quite some time. So I think it's in the horizon in the year end. I'd be very surprised if it gets enacted past 2020. But if you also look at, some indicators that might give that away, the SEC about a month or 2 months ago announced kind of relief rule changes to the Reg CF rules as they are. You don't need to have financials in order to launch even, or you can have self-certified financials and raise up to 250,000 instead of 107,000. So the SEC is already in COVID thinking about ways to help businesses, and they have this proposal that's sitting in their lap that they really put out there pre-COVID, that if they enact will help the industry more so than any kind of temporary relief change. So I think it's in their best interest, and they've certainly shown the willingness to move the industry forward this year. So I don't think there's any better time than this year to put that through. And again, I think it'll be just a massive game changer for the industry in general.
Thanks. Jovan, what's your take on that? I see you nodding. I also was curious, do you have any leverage, or I know you all have a relationship with the SEC on some level or another, any leverage to twist their arm or get, what's holding it back? Obviously the pandemic, that's just a great excuse, but is there less people, less process, they wait and see? Any opinion on what's the holdup right now?
Yeah, so I was nodding my head first of all because I was just in violent agreement with everything that Alan was saying, and I think what was done in the context of the relief around COVID and the reviewed financials that he mentioned, and the reduction in the statutory waiting period in order to close a transaction, to me is a great leading indicator that that the SEC is looking to do something to give relief to small business, and want to continue to be supportive of this. In the context of, do I have any inside scoop as to what's going on or what the holdup is? So Youngro Lee is our CEO at NextSeed, and he actually sits on the SEC Small Business Advisory Committee, and so is kind of at the table for a lot of those discussions. I don't know anything over and beyond kind of what Alan stated. I don't have any particular insight as to, I don't know that there is a holdup. My understanding, again, and I'm a couple of steps removed from it, is that these proposed rules or proposed rules were to be promulgated, were kind of put out for some type of a comment period or some type of a reaction. And so I don't know that there's necessarily, to my understanding, a delay insofar as getting them implemented, as much as it's following the regular, ordinary course of, Washington, due process. Yeah. But again, having said that, we're very privileged at NextSeed, obviously, to have Youngro, with a seat at the table in these discussions. Unfortunately, I just don't have any further clarity or insight than again what Alan suggested, which I think is spot on.
Figured if we all got together and went over there, they might rush it along. But Stefan, any thoughts? And is WeFunder doing anything to prepare for that change? Because obviously we got a 5x on the average raise potential. What are you thinking along those lines, and any enhancements coming down or any changes to prepare for that? I think it will change in my opinion, it probably change the face of what we're doing right now.
Yeah, quite a bit. I mean, I think very much to my peers here's point. I think there's definitely going to be an influx of better companies who never would have considered crowdfunding before, when it was an option just for $1 million. When you get to $5 million, you start talking about the amounts of money that among the best companies that Y Combinator is, and that suddenly becomes an appealing thing for kind of every startup, basically everywhere. So we're also pretty enthusiastic about that upcoming change. I'd say I also don't have any inside scoops, but we're optimistic that the SEC will continue to be a great partner on this, and that they're working through it, and hopefully it comes soon enough. And we're building out some interesting tech that'll help us take full advantage of it.
Fantastic. I'm gonna ask you another question, Stefan. As far as helping the startup entrepreneurs that are considering equity crowdfunding, I kind of want to go back that direction. What would you say the number one mistake people that are applying for that don't qualify, what is the number one mistake that people are making that they could be doing better to get listed or to be at a level that makes sense? What's that number one thing, would you say?
Yeah, I mean, I'd say there's definitely, if you're running a really tight ship, if you're leading a good business, crowdfunding is going to be easier for you. If your books are out of order, if you have no idea how to talk succinctly about your business, if you have no idea who your customers are and why they might love you, you're going to have a much harder time. So really, it comes back to the fundamentals of if you know what you're doing, if you can describe what you're doing and why it's important to the average person on the street, you're far more likely to have a successful crowdfunding campaign and be the type of company that we'd want to have on WeFunder.
Jovan, what's your advice? What's the common mistake everybody's making?
I mean, look, mine are really pedestrian, but I see them so often that I just have to mention them. You know, we see a lot of people applying to our platform, honestly, who have abysmal personal credit scores. And obviously, one of the things we do from a regulatory perspective is also from just a prudent diligence perspective is we run credit checks on folks. And so, you know, one of the things that I'm always surprised by is, you know, and maybe it goes back to your entitlement comment that you made earlier, you know, the idea that someone can come in with a 500, you know, credit score and expect that people are going to be, you know, tripping over themselves to throw money at them. You know, if you can't kind of deal with your, you know, your own personal deal, you know, I don't know that I want you handling my money. You know, I hate to be harsh, but I think that's just something we see so often that it's a perpetual head scratcher to me. The other one I think is, you know, we see a lot of folks come in who are looking for all of their expansion capital or all of their, you know, growth capital, et cetera, raised through NextSeed. And again, this gets back a little bit to what I was saying about the 80-20, et cetera. You know, there's nothing inherently wrong with saying that we need, you know, that you want to raise all the capital for your build out or for whatever it is that your use of proceeds is through the platform. But you know, it's a much easier story to talk to investors about, and it's a much easier diligence process. You know, for a lot of these early stage companies, they don't have long operating track records. So what we really have to look for is how are the owner and the operator's incentives aligned with the investor's incentives. Having someone show up who has some skin in the game, who actually has some cash in the business that they're willing to invest, you know, alongside the crowd is a powerful signaling, a powerful signal. And, you know, again, I think one of the things that always gives us pause is when someone is really kind of looking to say, I'm looking to raise all this capital for NextSeed. I don't really have any friends and family who have wanted to commit to this. I'm not really putting any of my own money into this thing, you know, but, you know, what can you do for me? And to me, again, it's simplistic, but it's so obvious. But I'm surprised how often we continue to see it.
Yeah, and that is the rub. I think that is right in that mode of it. It's a great platform to expand an existing success. And not just your platform, all, you know, equity crowdfunding as a platform. It's not a Hail Mary play. It's not a get lucky. Of course, that'll happen occasionally, but it's an accelerator and it's a catalyst, and it's a way for you to collect those funds easier in one place and then also advertise it. So I see it as a vehicle, but I do meet way too many people that think that they've won just by getting the phone call with a platform, right? And Alan, what's your take? What's the number one mistake you're seeing over there?
I think it's going back to an earlier point I made. When we look at founders and their willingness to put themselves out there, I think equity crowdfunding inherently deals with crowdfunding, and crowdfunding is a lot about marketing itself. So if you have a founder that really understands what it takes or is willing to be guided and willing to be advised on what it takes for an offering to be successful in crowdfunding, whether that is going out to your existing base or putting aside a budget for a paid media or digital media campaign, or reaching out to your friends and families in different ways that can really kickstart the campaign. When you start to get those conversations flowing with the founders and they start to really understand equity crowdfunding, it just puts us more at ease, especially if they don't necessarily have the traction points as other campaigns do that may not need to rely on those facets. So I think the biggest mistake that we see, and it's starting to get better and better as we improve our screening process and make sure that we onboard every company that really understands what we're trying to show as a model for success, is the ability to just take full advantage of a platform without lifting a finger from a founder's perspective. we would love to, and there certainly have been some offerings that, we funded an offering in 9 hours and it hit the $1 million max. And I know the other platforms have had similar successes. And that's incredible. But for the majority of the companies, it takes strategy, it takes advisement, it takes potential dollars to be spent. And if you're a founder that thinks this is a platform where you can divert your attention elsewhere and focus on other things, you're going to be raising well short of what you could have in equity crowdfunding. And it's not going to be worth it to you to put the time in. And certainly it's a lot of resources that each platform diverts to each offering to make sure it's successful. So my biggest piece of advice for a founder is understand that it is a brand decision for your business. It's something that you'll have to work towards to be successful. And if you understand that, then you're going to be very willing to hit the ground running when you've got an offering live, and you'll put yourself in a much better position to succeed.
Thank you. When the industry first started, I would look at deals and listings and kind of make my own judgment on how well they were going to do just by appearance marketing. Oftentimes, though, I was surprised at ones that I thought would completely fail, and there they are breaking records. And I won't name any specific names, but a few that I thought just never would win, maxed out and broke records. I guess, is there any stories, or how often does that happen to any of you, where, of course, anybody that's listed you have the best wishes for and expect it to go, but maybe it closed in the first week or two? Do you see that very often? Does it surprise you like it surprised me? Stefan, anything like that?
Yeah. I mean, I'd say there's definitely. My guess is everyone on this call has a couple of specific companies they're thinking about who have done well, perhaps on other people's platforms that we all might have not personally invested in.
Passed on.
Yeah. And I think that's natural to happen. I mean, on one hand, you can have a very rational economic argument for it that the crowd is better able to make a decision as to whether or not these are good investments or not than us personally. And it remains to be seen in many of these investments whether the crowd will see their great return, or whether our personal judgments were in fact correct, that those were good things to pass on. I think we're in the early enough days of crowdfunding, much like the early days of the stock markets, where there are practices that are happening right now that probably won't be done in 20, 50 years. And some of what my guess is, as the market continues to mature, it will make a lot more sense who wins and who doesn't.
Awesome. Jovan.
So, look, I mean, obviously people invest, and the way we think about our offerings is, of course, it's got to stand on its economics. That's first and foremost why people invest. But also there is a community building aspect to it, right? And that community can take the form of geography. Someone wants to support their local neighborhood bar or restaurant or Pilates studio or whatever. Or it can be affinity groups, or just things that people feel strongly about, and it just hits a certain nerve with investors. And so what I would say is that there have been certain offerings I can think of. We actually did one in the heart of the COVID thing for a company called Authentically American. It was basically a veteran-owned, American-made apparel company. It was a small deal. It's $500,000, but it was subscribed in very, very short order. And it's not that the economics, the economics were very strong, obviously, but it moved really, really quickly. And I think it was just because in the context of everything going on with COVID and, whatever, this idea of, made in America just kind of hit a nerve with everybody. And I don't know that you can kind of capture lightning. It just kind of happens sometimes. So to me, that's an example of a recent one where, there's something over and beyond the economics. It's kind of, you hit the right affinity group, or you hit the right theme at the right time. And there's just a groundswell of subscription and interest that happens quickly. So it happens. We don't count on it, but we see it actually, reasonably often, which is a nice position to be in.
Thanks. And Alan.
Yeah, I think we can't be in the business of predicting hits. It doesn't work in the venture capital industry, and it doesn't work in our industry. I think the beauty of equity crowdfunding is that we don't have a portfolio limited to maybe 10 companies where that one needs to be a success for the investors of the fund to make a sizable return on their money. So I think, yeah, I mean, there's going to be surprises, but every time it happens, it just validates why equity crowdfunding is needed, because, you know, you're looking at a business that maybe the four of us pass on, but thousands of other people are really excited about. And we don't have we don't know much about the industry that the company is in, or we're not a fan of the consumer vertical that, you know, there's so many different factors that go into whether someone attaches to a business. And of course we have certain screening requirements just to make sure a quality level is maintained on StartEngine, and that keeps increasing year over year. But, you know, every time it happens, I smile, because, you know, that's good. You know, I don't want to be the person to pass on the entrepreneur. I think it's the purest form of whether or not an entrepreneur gets feedback is going directly out to the crowd and seeing, listen, if StartEngine or WeFunder or NextSeed pass on the company, that's a decision made by maybe 10 or however many people. But if they launch on one of our platforms and potentially hundreds of thousands of people see the offering and nobody's biting, I think the entrepreneur gets a very realistic sense of the business. So I think the idea of surprises is welcome, and it's going to continue to happen no matter how high our quality standards are. But again, I think that's kind of the beauty of the industry we're in.
Wonderful. So I'm going to wind it down with one last question. I wanted to thank you all for taking the time to talk with me, with each other, and the audience, the startup crowd out there that are considering crowdfunding, crowd investing. If I'm that CEO, I'm that founder looking to raise money through equity crowdfunding, and I come over to your platform, would you mind just kind of stepping through what to expect after they do submit that application, or even the you know, staring at that application in their face? Some of them are a gauntlet and it takes work, and, you know, I think that's valuable. But what can you walk through from filling out the form to how long should they expect to wait, and then what happens next, just so they can get prepared for what that might take as they consider listing with one or all of your platforms in the future. I'm going to go to Jovan.
Okay, thanks, Travis. So the process is, once we get we have obviously we have a secure web portal where all the information can be uploaded, and then that's available to the underwriting team, of which I'm a part. It takes us generally about a week, 10 days, once we have all the information, to do our diligence. And basically the idea is that we come back to the issuer and we say, look, this is kind of the terms that we would propose. This is the type of security that we would propose based on, you know, your business profile, where you're at, et cetera. So call it a week to get the kind of our proposal back to them on what we think we can do for them. If the terms are acceptable and they want to move forward, the next thing is that basically there's a month that we spend kind of on a pre-launch basis. And there's two things that are going on during that pre-launch basis, or during that pre-launch period. The first one is there's a lot of regulatory and compliance diligence, and, you know, checking articles of incorporation and everything, and making sure all the I's are dotted and T's are crossed. But the other thing that we're doing is we have a internal dedicated marketing team that's working with the issuer and their marketing folks to figure out what is the campaign going to look like when we do go live. You know, we spend some of our own social media dollars to actually promote the campaign. If it's something that makes sense to have, you know, in-person tours. If it's a construction project, we'll have hard hat tours, et cetera. So there's a month where basically we're prepping the campaign, we're getting everything ready to launch. And then generally speaking, call it then, you know, 5 to 6 weeks after we've gotten all the information, we've done our diligence, and then we're basically going live with the transaction. Depending on the size of the transaction, I think our average you know, kind of closing time or full subscription time is about 75 days. So we generally suggest that folks leave the transaction open for 2.5 to 3 months, with the idea that obviously it can be truncated if things, you know, eventuate more quickly than than that time period. But it's always easier to shorten the transaction than it is to kind of reset it or kind of extend it if we need to.
Great. And Alan, how are things over there?
Yeah, so we've got a full-time sales team that hopefully is responding to every inquiry within 24 hours. That's kind of the metric we set, but sometimes it's very tough to hit that with the increase of leads or companies that are interested in speaking with us. So we have an application. It's not designed to be anything kind of material that you wouldn't want to share, that you can fill up or fill out within 5 minutes of your time. It'll give us just a top line review of the business. And if it's something that we don't think is a fit, we'll let you know, and we'll also provide other platforms out there that might be able to look at your deal. So we want to promote equity crowdfunding, and just because it's not a fit for us doesn't mean it's not a fit for any platform out there. But if it's something that fits our bill, you'll speak to multiple different team members, and then eventually you go through a screening process, sort of like an investment committee, where we'll review the deal. We'll talk about the tangible aspects of the business, but also what we talked about. Does the founder get it? Are they excited about equity crowdfunding? Are they willing to put themselves out there? So there's a lot of tangible and intangible metrics being discussed. And then, especially due to the COVID relief, we've been able to launch companies with under a week, under 2 weeks time. So a very quick turnaround time to actually launch on StartEngine. And then, similar to Jovan, we usually launch companies with a 60 to 90 day horizon. Sometimes companies get filled up. We just had one company called Streamlytics that oversubscribed $1 million in just a week. Certainly that's more of the exception, but 60 to 90 days is a nice window to provide a good enough time for investors to come in, but also some urgency to other investors that maybe are thinking about it but are looking for momentum. And then if you aren't able to reach that maximum, one of the best things about StartEngine that we provide to our companies is the ability to disperse on funds multiple times throughout the offering. So you don't need to make a decision, do I close now because I need the money in order to use for my business? You can actually keep extending your campaign until you reach the maximum of 1.07 and be able to disperse out chunks of 50,000 or 100,000 each time as you go. So it's a very flexible way to raise capital, and we work our hardest to not only onboard companies as a quick enough period of time, but assign them to another role we call a campaign strategist, similar to what Jovan mentioned, a dedicated person that is working with them on all types of marketing strategy, whether that's building and designing the campaign page, to what does launch day look like, what is week 1, week 2, and how do we analyze and optimize the campaign from a crowdfunding marketing perspective. That's certainly a skill set that we've learned over the years, and a lot of companies come into equity crowdfunding not understanding that. Maybe they're very adept in marketing their own business, but taking on investment through digital means is something that's a little bit different. So we put a lot of emphasis into customer service, into flexibility of the offering, and hopefully we're able to provide a great experience for our founders.
Thank you. And Stefan, what's your take? What's the process back at WeFunder?
Yeah, absolutely. So I'd say there's kind of two big main differences. We built a lot of tech, which allows some founders to go directly from beginning their application to starting to circulate a completed profile to drum up interest from close family members, close friends in the same seating. So you could literally sit and launch an initial campaign today, right now, before even talking to anyone on our team. But as those applications, as those completed profiles come in, our BD team, which is a team of mostly former founders, look through those companies, look through which are the ones that in the long term should stay self-service, which are the ones that are really the ones that we should get in touch with and engage with, and start talking to them to go through a couple of different screening panels to see if really these are the companies that we should be particularly highlighting on our site. And that tends to be some number of conversations before we're confident, at which point we bring you over to our account management and regulatory compliance team, which helps you set up everything else for the broader campaign. That's usually a quick meeting and a couple of emails back and forth. And from there on out, we can launch you on the site, and you can go do your campaign. I'd say similar to everyone else, we also recommend 3 months on average. But one of our account managers is actually as a side thing, he has a boat chartering business. There's many founders and former founders on our team. So Justin then works with many of these companies very closely to make sure that their campaigns are going well. That could be both checking in to see how individual investor conversations are going, how they're thinking. We refer out to some marketing support. We don't do that in-house. But yeah, we do everything we can to make sure that throughout the entire process, you're talking to people who have been in your shoes before and can help guide you through exactly what equity crowdfunding means for a founder like you.
Wonderful. Well, again, I wanted to thank you all for being part of this panel. And more importantly, what you all do for the industry and founders out there. You know, without equity crowdfunding, without top tier platforms like yourselves, there'd be thousands of companies struggling to get started. It's part of the reason I'm here. I think early stage companies and startups are really our best chance at improving the world. And I think together you're all, making that a reality. So I want to thank you again for being part of this Newchip experience. Thank you so much.
Thanks,
Travis. Thanks for your time. Thanks, guys.